Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Wednesday edition, it's the Hump Day edition of The Real Investment Show, of course, with Danny Ratliff joining me this morning. Talking about 2023. Yesterday, if you missed it, we did our economic outlook. We answered a whole bunch of questions for an hour from viewers who were asking everything about everything from gold to bonds to market outlook to what's going to happen next year. That replay will be up on our website in the next day or so. Brent's just going through his magical editing down to get that all worked out. But we'll have that up on our website on the main page, realinvestmentadvice.com, so you can download that, watch that. Again, we answered, the whole hour was nothing but just answering viewer questions. So again, a lot of the stuff that you're probably interested in, we covered that yesterday. And don't worry, we'll be doing that again soon, next year. So once we get to the new year, we'll do like a year preview. So we'll talk about what we expect then. But, that's going to be the big topic for today, of course, is, discussing what 2023, might have in store for us a little bit. And is there a big surprise? And it's interesting because right now everybody's super negative. And that's okay, right? Everybody's very, very bearish. The problem is there's nobody that's bullish. And from a contrarian investment standpoint, typically that turns out to be the time that, and this is something we discussed yesterday, that's the time maybe you want to start looking to buy stocks. I know that's hard to imagine right now. It's like, oh, there's a recession coming, there's all this. Yeah, maybe. And as we've talked about before, there's no guarantees that anything will happen exactly the way that we think. And generally, when everybody thinks, this is Bob Farrell's rule, investment rule, which is that when all experts agree, something else tends to happen. Well, right now, everybody expects there to be a recession next year. Now, again, it's hard to imagine that you wouldn't have one, giving the Fed hiking rates at the most aggressive pace in history and weaker economic growth and all these type of things, right? But again, when most people expect something to happen, something else tends to occur. And that's just the way markets work. Markets always tend to do exactly the opposite of what you think they're going to do. Okay, but we'll get into that this morning. This morning we have earnings coming out, of course, and then retail sales. That's going to be the big kind of data this morning. Expect retail sales to be a little bit better than expected, possibly coming in around 1 to 1.1%. And why, pray tell, will retail sales be better? That's because of California stimmy checks. Don't forget that just recently California passed a stimulus check program to help consumers in California out with their gas costs, because oil and gas in California costs you a whole lot. It's like over $6 a gallon for gasoline. They all needed a little bit of help from the government, so the government sent them checks. Of course, every time you do this, two things occur. One, yes, you get a pickup in spending because people don't save money, they spend money. Particularly if you give them free money, they're really going to spend that. Second thing is that also helps support inflation. So, this may help, keep inflation hanging around here a little bit higher level for longer, especially on the core PCE side, core services side. But anyway, nonetheless, the stimulus checks in California, big surge in spending last month due to that. Also, remember, this is the data for October, which, of course, that includes Halloween, which is one of the second biggest shopping days of the year. So it won't be surprising to see a little bit better than expected retail sales today. That should potentially help markets theoretically, right? Because it shows the consumer is still strong. But on the other side of that, consumer spending very strong is also something the Fed's trying to curtail. We need less demand in the economy to bring down inflation. So if the number comes in too strong, that might actually spook markets here a little bit, thinking the Fed will remain aggressive at this point because of the risk of higher inflation. So again, it's going to be one of those double-edged swords this morning. It's almost like Goldilocks, right? It can't be too hot, it can't be too cold. It's got to be just right on that retail sales number for the markets to respond positively. Outside of that, also, when you start thinking about retail sales, where's the money coming from for these retail sales? That showed up in the credit card survey report out yesterday. Big surge in credit card spending. Again, consumers turning to debt, short-term debt, credit card debt, in order to make ends meet, buy things, those type of stuff. So not surprising with Halloween. Everybody wanted to dress up and decorate and buy candy. Candy, of course, very expensive for Halloween. All went onto the credit card. So we saw a big surge last month in credit card debt. Again, not surprising as consumers continue. There's no savings for the bottom 90% of the population. Savings rates are dropping to below pre-pandemic levels. So again, if I've got to make ends meet, where do I got to go? I got to go to credit card debt. Now the question will become ultimately is when we begin to see consumers getting tapped out on credit. In other words, there's a point to where banks are going to go, Brent, quit asking for more credit card debt. We're not going to give you any more credit cards, right? You're completely maxed out. And there is that point. There is a point to where credit will become unavailable because when you go to apply for a credit card, your debt to income ratios simply just don't line up. And this is interesting, right? I'm hearing a lot of commercials on the radio as of late, television too, for mortgage companies saying, hey, this is a great time to take the equity out of your house and pay off that credit card debt. Now, that's an awesome idea, right? Mortgage companies nobody wants to get a mortgage right now because of where mortgage rates are. So nobody's going to refinance their current mortgage into a higher rate. That's ridiculous. So the only way to really do anything on the mortgage side of the ledger is to get people to cash out the equity in their house, take out a home equity loan in order to do something else with, right? Go on that vacation, pay for college, or pay off that high interest credit card debt. Now, in theory, this is a great idea, right? I can take 18-19% credit card debt, swap that out for say 7.5% mortgage debt on my house. That's great. I extract the equity from my house. I now lower my interest rate on my credit cards, pay those off. But the problem is the consumers do this and then do what? Turn right around and run the credit card debt right back up again. So now they've got the mortgage debt on their house, plus they wind up running back up their credit card debt. So again, if you want to do that, if you want to take out a home equity loan on your house and pay off your credit card debt, absolutely nothing wrong with that. But you cannot go back into credit card debt. You've got to cut all your credit cards up and you're done on credit cards until you pay off that loan on the house. You're just shifting the balance. So you can't go back and run out credit card debt all over again. But this is not what most people do. They wind up with even more debt. And this is why we have such a debt problem in the country, and why when you start talking about debt to income ratios and those type of things, you see these debt to income ratios like, oh, the consumer household balance sheet's very healthy. No, it's not. It is only healthy in the top 10% of income earners that have no debt and lots of savings. Everybody else is struggling with a lot of debt and no savings. The average person, we talked about this before, 65% of Americans living paycheck to paycheck. The average household basically has less than $500 worth of savings in the bank to meet an emergency. That is not a healthy household balance sheet. And when we get into next year, that's where those cracks in the foundation that we've been talking about for a while are really potentially going to show up. But again, as I said, there's certainly lots of evidence that we'll have a recession next year, or at least should have one. But again, don't invest that way. And this was one of the key points yesterday, is that you've got to manage the risk in your portfolio to invest in whatever market comes, and betting that something's going to happen tends to not work out as well as you think. All right, quick break. We'll come back. We'll talk about 2023 with Danny Ratliff. Don't go away. You're listening to The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So student scores have fallen on education tests ever since the switch to online learning. Who would have thought that was going to happen? I can tell you, with 4 kids in the house all doing this online thing, you didn't have to do a whole lot of that, right? Were your kids doing a lot of online?
Yeah,
Danny?
we were doing it.
Danny's here, by the way. Hi,
Hey,
Danny.
guys.
Good morning.
Good morning. How are y'all?
So did you have a lot of, because my kids were, in high school, basically. So
No, so our problem with the online was that our kids are so young, you literally had to hold their hand through it all because, after a while they'd start teaching you how to use the computer, but
yeah,
it took a minute.
yeah. So, it's in my house, it was, they've got one laptop with, their online learning, and then they're doing 12 other things at the same time, right? Yeah. So they're on their phone or whatever.
We didn't have that problem.
And my son was creating an online business at home by taking everybody's physics exams and getting paid for that. And the way I found out about that is I got a call. So my son's whip smart, super book smart, dumb as a rock when it comes to common sense. But I love you, Tommy, if you're listening this morning. But anyway, so he's super smart. He doesn't have to study. He looks at something one time and he's got it. And so so people were paying him $20 to take their physics exams for him. And I get a call from the principal at the school, and he's like, Mr. Roberts, we're going to have to suspend your son for 3 days because he was caught cheating on his physics exam. I'm like, what? And he's like, yeah, your son was caught cheating. I go, that's impossible. He doesn't cheat. He knows better.
He doesn't need to.
He doesn't need to, right? And like, well, he did. The way we know is that we give out randomized tests, and he turned in a test with his name on it that was the same as this other kid's, whose name happened to be Thomas. So it turns out I go confront my son with it, and he says, I can't believe I did that. He says, I took the test for Thomas, and I actually turned his in. I thought it was mine, and turned it in. And anyway, so for this, he makes $20 a test. He wound up spending 30 hours in detention over this.
Oh, wow.
Which was partly my doing. I talked to the principal. I was like, I need a really long detention sentence for this. Now, my son doesn't know that, but
yeah, he may now.
He may now, but Anyway, that's what happens with online learning, right?
We were just trying to teach our kids to read at this point. Like, okay, here's what this means. I mean, I think we were like second grade and kindergarten and pre-K. So
yeah, I know. Well, my wife and I just, we encode messages at our house that we leave for each other. We just write in cursive. So
there you go.
So anyway, but yeah, online test scores have fallen sharply over the last 2 years due to pandemic. And of course, everybody's going, oh, it's all the pandemic. That's why kids are having, learning problems. No, there's a lot of other problems. Also has to do with what you're teaching kids as well. But that's a different story for a different day. Anyway, morning, Danny. How are you?
I'm doing great. You?
We're doing well. So yesterday we did our economic kind of outlook for the year, answered a bunch of questions. Kind of what was your takeaway yesterday?
I think that there's still a lot of uncertainty and people are concerned. And, rightfully so. I mean, you look at the numbers, just right now, somebody just wrote in, TK said on YouTube, hey, does Amazon letting go 10,000 people before Christmas portend a recession?
No.
But it doesn't look good, right? I mean, you have FedEx laying people off. You have all these companies. And, I think that people are beginning to become a little bit more concerned. I mean, markets have been really good. So it's interesting because from week to week, I think people's behaviors, their perceptions changes. And so it's difficult to navigate in this environment where, we have a really good week last week. I mean, a great week. And hey, we got to be in. People who want to be out are, they're a lot more anxious to put more money to work.
Right.
Whereas, this is probably a time that maybe we need to start, taking a little bit back off. But, I think that there's some good things that are coming, right? We see that we're going to have gridlock in the political spectrum, which is going to be great from a financial planning perspective. We're going to get a little bit more leeway potentially where we've had to, planning year to year has become pretty difficult. Markets, obviously, I think are the biggest concern at the moment where we've had anywhere between a 15 to 30% drop in just the last month and a half, 2 months. And people just don't know where to go from here. And, now we're hearing rumblings that, okay, we're actually going to be in a longer recession or get into a recession here in 2023. What does that mean? And what should people do? We've had everything from I have too much cash, need to put funds to work, from I'm still 100% invested, how do I get to more cash? Mm-hmm. So, I mean, every question you can think of, it's all over the spectrum at the moment. And, I think that's why we try to do these things. So if you didn't get a chance to attend yesterday, you can go to the YouTube channel. Brent, is that up yet?
We're gonna post it on the front page of our website. So if you go to realinvestmentadvice.com, it'll be right there on the front page.
Perfect. So just an hour. So we do these candid coffees, and it was designed during the pandemic actually because we couldn't get in front of people, and it's kind of just like office hours and say, hey guys, just random fire. Give us some questions you have. And a lot of people probably have very similar questions. So that's what we were doing these for. We're going to continue doing these here in 2023. But, I don't know, Lance, what did you take? What was your biggest takeaway?
Basically, it's the interesting side. It's about psychology, right? Yeah. And as I'm fascinated by human psychology and human behavior, and it's a function of managing money, right? I mean, this is what happens after 30 years of managing money is that you become really a student of investor behavior. And look, we all are. I'll spit that out. We are all subject to emotional biases, right? And this is the thing. And look, even now, I mean, after 35 years of doing this, and Mike's been doing this for 30 years, and Nick's been doing this for about 4 months because he just, became a teenager. I'm joking. He's very young. Anybody below 40 is a kid to me. So just there. Anyway, Danny, almost out of diapers. So, but the point here is that, we're all subject to these emotional biases. The trick to managing money is being able to set those aside and say, hey, I know what my gut's telling me, but this is what the detail, this is what the technicals are. This is what the fundamentals are. And the one thing that we've always got to remember, and this was the big takeaway from yesterday, everybody's bearish, right? Everybody's a recession's coming, the world's coming to an end, I'm all in cash and this type of thing. Maybe you're right. Maybe that's possibly correct. And there's certainly, as I was saying just a moment ago at the open, right? Fed's hiking interest rates, most aggressive rate hike in history. We've got layoffs, and so clearly we're going to have a recession next year. The problem is that markets have never predicted a recession ever, right? This will be the first year, if we have a recession next year, this will be the first year on record where you have an accurate prediction of a recession. And now I'm not saying that's not going to happen. I'm just saying that historically, when the market expects something to happen, something different occurs. And so that's why as investors, we have to be aware that our psychology tends to be wrong, particularly the herd tends to be wrong at turning points in the markets. And again, you take a look at the negative sentiment in the markets now. I can't find anybody that's bullish, right? I mean, even Jim Cramer is maybe a little bit bullish, but he's not even all that bullish. So these are the things we got to be careful of. What happens if is the things we need to think about. If we're 100% cash in a portfolio or 90% cash, whatever, what happens if the market takes off running? Are you going to be able to get back into the markets? If you're 100% equity and the market begins to crash further from here, what are you going to do, right? These are the things that you have to think about and have a plan for, particularly as we move into next year, because there's no guarantee how next year is going to work out. No,
that's exactly right. I think that it's interesting because people are so matter of fact. Okay, we have layoffs. This means we're in a recession, right? Or this is happening, so now we need to do this. Where I think you need to look at both sides of the coin, and that's one of the things that I think we've learned, and I've learned over the years, is that you can't have a strategy for just one direction. Mm-hmm. You need to be able to have one for both, and having that discipline, I think, that really helps kind of keep you balanced and taking a more fair approach to it versus saying, all right, we're going to be in the bunker. Well, guess what? We know a lot of firms that are in the bunker. They've been in the bunker for many years, and they're going to stay there. And someday they're going to do fantastic. But and vice versa, right? You get the other guys that are just 100% bullish. The problem is that the math of loss does not work in your favor if you're always on that side.
Yeah. Well, and let's talk about layoffs here real quick, right? So Amazon's announced 10,000 layoffs. Facebook, Meta, whatever they want to call their names, Zuckerland, he's laying off 11,000 employees. We can go down the list, right? Yeah. A lot of tech companies laying off employees. But now let's talk about Amazon for a moment. They're laying off 10,000 employees. They have 1.3 million employees, maybe 1.4, closer to 1.4. So 10,000 is not that big of a number relative to their total employment. And really what they're laying off is a lot of the over-hiring they did because of 2020, 2021, when we had this economic shutdown. We had all this demand because of stimulus checks. So a lot of these layoffs that we're seeing, yes, we're getting layoffs, which we would expect to have as the economy slows down. But a lot of this hiring is just excess hiring where they overhired people during the pandemic, and they're kind of trimming back to what their normal run of employment is. Now, what you're looking for is, of course, more important sectors of the economy that suggest that the economy is really starting to decline, right? You're not seeing layoffs from companies like ExxonMobil, Chevron, right? They're not laying off workers. You're not seeing workers.
Yeah, but they already did. I mean, that's the kicker, right?
Well, they laid them off in 2020, right?
Correct.
And so they're actually hiring back. Here's my point, though. We can't look at just one sector of the economy and say that says they're laying off people. And most of the layoffs right now are in the tech sector. And I'm going to get to FedEx and Maersk here in a second, but just follow me through.
Yep.
You want to also be looking at the other sectors of the economy, the industrial sector, the material sector, those type of, kind of the manufacturing side of the economy. You remember back in 2012, we had a recession in 2012. It was never classified as a recession because it was only in the manufacturing sector of the economy. The services side was killing it and doing great, right? So we never had a recession. Right now, we've got a recession going on in the services side, the tech industry, right? But not necessarily in the manufacturing side of the industry. But, FedEx is, potentially going to lay off, or they are laying off workers, as the economy demand slows down. Supply chains are coming back into balance. We're starting to see that. Maersk showing a decline in ships. The LA port just said they had the slowest rate of ships coming into their port since 2009. Certainly some indications there's some slowing down, right? But we haven't got there just yet. We'll talk some more about this on the other side of the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I can bet on the 100-to-1 long shot in a horse race, but odds are if he's 100-to-1 to win, he's probably not going to win. This is like Brent in a foot race with Usain Bolt could actually win, right? There's a long shot to that.
The Real Investment Show podcast. Same show, your schedule.
I wouldn't bet on it.
At realinvestmentadvice.com.
Because Usain Bolt could probably crawl to the finish line faster than Brent could get there.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, healthcare benefits. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. It's the Real Investment Show. Danny Ratliff joining us this morning. Just to wrap up here on layoffs, the point here is with layoffs is that what you're looking for is a very broad swath of layoffs across the country. In other words, basically all sectors of the economy starting to lay off employees and laying off substantial numbers of employees, right? That's what shows you that businesses are contracting. Right now, we had a lot of hiring, right? You had a lot of truck drivers, as an example. You had a lot of truck drivers hired because there was a shortage of truck drivers. And now that demand is starting to slow down, there's an excess number of truck drivers, so you have to fire some. Same way with shipping, same way with Federal Express. There was all this demand to ship products, so they hired a bunch of workers to ship this demand. That demand is now slowing because we have a slower economic environment, and the supply chain imbalances are now coming back into balance. And this is why you're starting to see inventory builds at Target and Walmart and others. And now they're trying to lick the Amazon Prime, recently having 2 Prime days to try to get rid of excess inventory. So as the economy slows down, those excess employees are getting fired, but that doesn't mean that they are actually contracting their employment in terms of a recessionary drag. Now, I'm not saying we're not going to have a recession. Don't run off and say, oh, Lance says there's no recession coming. I'm not saying that. We just have to remember there was a rush to hire a lot of people because of all the stimulus checks and the shutdown of the economy. Now things are kind of coming back into balance of the supply-demand imbalance. That's coming back into balance. So excesses are getting reduced. Now, if the economy continues to slow down next year, yes, we're going to have more layoffs. And once we start seeing consistent layoffs across companies, that's going to be your real indicator that we're in a recession. And that occurs, again, we won't know we're in a recession until after the fact. But when you see layoffs really starting to spike higher, starting to see the unemployment rate spike higher, start to watch the labor force participation rate drop, that's when you're going to be in the recession. That's the thing you're going to really be looking for on that employment side of the data.
Well, and that's one thing, though, that I think that's why it's so important to follow some technicals.
Yep.
And understand that, hey, it's time to take chips off the table. It's time to add a little bit. But don't do all or nothing, because that's when you get in trouble. Because think about how many times, in June, and then at the
end of September,
everybody's saying, "Get me out!
Yeah.
I want all the way out." And then you missed out on a 17% run or a 14% run. I mean, that's pretty significant.
Yep.
And to be all the way in cash and watch that, you're just locking in those gains or losses at that point.
Yeah. Well, and again, this is, I wrote an article, right at the end of September called, a big short squeeze is coming. Yep. Because everybody was so bearish, right? It was just everywhere you looked, you had uber bearishness. And that's a great setup. And we had said the same thing back in June, that we were so bearish. I was on Fox Business with Charles Paynes a couple times saying, hey, we're about to have a rally here because everybody's bearish, right? The sentiment is so negative, it's got nowhere to go but up. Now we're starting to get back to the other side of that. Everybody's starting to, as Danny, like you said, when we start getting phone calls like, hey, get me in, that's generally the time we want to start selling. So,
yep.
And we've been selling for the last couple of days, right? Taking a little bit of profit, reducing equity exposure again, raising cash, because there's probably some upside left in this market right now through the end of the year for a variety of reasons, but there's probably not a lot left. So, you don't have to wait until you don't try to pick the exact top to sell. That's where you get on the wrong side of the trade, because this market can move very fast. As you saw last week, you get a 5.5% move in one day. If you're not in, you missed it, right? It's and this is why we always maintain some equity exposure in our portfolio, because when you have these big 5.5% up days, it can do a lot for the portfolio, and then you can say, okay, I'm going to take that, I'm going to reduce some risk and rebalance and raise some cash. And then on the next decline, buy some more. And that's what we've kind of been doing all year right now.
Yeah, so what do you think about 2023 earnings? I mean, we're looking at the consensus earnings are still relatively high compared to where things are, right? I mean,
and margins. Yeah, corporate margins are still very elevated here. So margins and earnings both have to decline next year, which also means that theoretically prices have to decline because valuations are at 23, 24 times earnings. So if earnings decline, if the E declines in the PE ratio and price doesn't decline, then you're going to have 30 times PE, right? I mean, valuations are getting very, very high. So the P and the E have to come down. And more importantly, margins are going to be the big issue. One of the reasons that we've got record corporate profit margins is because of the shutdown. We shut down the economy, so everybody laid off workers. And then there's all this artificial demand from stimulus checks. So everybody boosted prices, but they didn't hire back a bunch of employees. So profit margins got really fat for companies in 2020 and 2021. We wrote a couple of articles about this. Now, the problem is that in order for valuations to stay where they are, corporate profit margins cannot mean revert. But corporate profit margins will mean revert. They just simply cannot remain at this level because we've now hired back employees. Inflation's declining, demand is declining, so profit margins have to fall, and we're seeing this in several different indicators. But those profit margins are going to have to come down, and that's going to weigh on asset prices next year. Now, it doesn't mean you've got to have another 30% decline in asset prices. It could just mean the market does nothing next year. A lot of flopping around like a fish out of water, as Gary Shandling used to say. You know that joke, right? Danny doesn't. Dan, do you even know who Gary Shandling is?
No.
Okay, first of all, you need to go YouTube Gary Shandling. Gary Shandling once said that, he said, sex is like a fish out of water. There's a lot of flopping around and gasping for air. So go look up Gary Shandling. Great comedian. Anyway,
right, I can handle that.
Yeah, he's actually, it's old-timer humor. Anyway, the issue is that as, the economy slows down, these margins will have to fall. So, but again, that doesn't mean that stocks have to decline another 20%. They could be down another 5%, another 10%. Sure, absolutely. But you've already wrung out a lot of this bear market over the last year just as grind. A lot of stocks are down 60, 70, 80% already. Valuations have come down a lot on stocks. And again, when you look at indexes, that's one thing. Look at individual stocks when you're buying them in your portfolio, because there's a lot of individual stocks in the index that already are trading at very deep discounted valuations, and those opportunities aren't going to last forever.
Well, that's a really good point too, because we did get some questions on, should I be investing on, in ETFs or individual stocks when we did our can of coffee yesterday. And so I think that's one we didn't really address very much because we just had so many questions come in. But that's a really good point in the sense that you can find a lot of good companies that are significantly discounted, or you can go buy the index. Which would you rather have?
Yeah. Well, and again, it doesn't mean that you could buy a value stock, and it doesn't mean that it won't go down some more if the market declines another 20%. It doesn't mean that value stocks won't go down some,
Yep.
But most likely they won't go down a lot. And a lot of these stocks are yielding 4, 5, 6, 7% dividend yields right now. So you get paid while you wait to work through whatever remains, in this market environment until we get. And look, the good news is that we're getting through this bearish cycle, and we'll get to the next bullish cycle. The question is just, is it next year, the year after that? I don't know. But eventually we'll get through this. We'll get valuations reverted back to some normality. The Federal Reserve will go back to doing QE and zero interest rates, and we'll start the next bull cycle. But you're just going to have to grind your way through here until we get there.
Well, and we keep talking about the 2023 recession and what's looming ahead. I think it's really good to put this in perspective in the sense that, okay, what if we are into a bigger slowdown? That doesn't mean the market's going to be terrible all year.
Right.
I mean, we may start the year off slow, especially if we continue to see some follow through with this rally here to the end of the year, which is possible.
Mm-hmm.
We get a little bit overextended.
Yeah. We would.
Yeah. So at some point you'd like to see chips come off the table, but I think that, looking at the bigger picture here can really be good in the sense that this may be that one buying opportunity you've been waiting for, especially if you've been in cash, you have funds to put to work, start putting funds in. We're not the biggest fans of dollar cost averaging just because of the way that it works. But if you can follow some technicals and understand when to put funds back to work or find some really good deals, that's the key.
Yeah. Well, and again, think about this year, right, as a good example. A lot of people talking about this. The market's going to decline another 10%, another 20%, whatever the number is. Pick a number.
Yeah.
So go back to June, and everybody was really terrible at that point, right? We're down 20% in the market for the year. Markets, everybody's negative, world's coming to an end. Then the market rallies 18%, 17, 18%. And then it declines 20%. And it gets back down to where we were previously with a 20% decline. So, we really haven't gone anywhere this year. There's just been a lot of volatility. And so when somebody tells you, if the market rallies through the end of the year, and let's say we get up towards 4,100-ish, right? So, then the market declines 10% from there. Well, that's 410 points on 4,100, right? So it puts you right back down to around 3,600. So it's kind of where we were. So, these declines are coming after advances. And yes, the declines feel terrible. They are certainly stressful. But, when people start throwing out these numbers like the market's going to decline 16%. I just read an article yesterday, that's why I bring it up. The guy, this analyst says, market's going to decline 16%. Great, okay. Puts you about back where you were. At the end of September, maybe a little bit lower. But again, these are the things you have to remember is that these bear market rallies alleviate some of that downside destruction. And as you're grinding through this market and grinding down these valuations and prices and stocks, it's providing some really good opportunities. So be careful. The whole point is just be careful looking at an index and making your entire investment thesis based on what an index is doing versus what's happening inside the index, which can be entirely different stories. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So my wife is traveling this week. She's in Washington, D.C. So, of course, Yellowstone premiered, and I can't watch it till she gets home. So don't send me emails telling me what happened. I know John Dutton becomes governor of the state. I know that part, right? That's just the whole premise. But don't tell me what happened. Yellowstone Season 5 premiere breaks ratings record with 12.1 million viewers. CNN's new morning show with Don Lemon got 400,000. So just saying what people want to watch. People want to watch Yellowstone. And it's not even filmed in Yellowstone, folks. It's in Utah. So,
hey, Brent, wasn't it pretty funny when Lance's face lit up? He's like,
you don't even watch Yellowstone. Have you even watched any of the episodes?
We actually did watch this one, yeah.
You watched the season premiere? Mm-hmm. Have you watched any of the previous seasons?
We have. We don't watch much TV at all, but we actually have watched that.
Yeah. I mean, they were
we watched little to none.
Yeah. They were interviewing the girl. She's British. I can't think of her name off the top of my head, so forgive me.
It freaks you out every time she starts speaking and like her accent.
Her accent, right? But she's British and she plays Beth Dutton, and she's this very wily, aggressive, hard-hitting lawyer that works for the family. And of course, some of the best lines in the entire show come from her. And they were interviewing her the other day, and she's talking about, it's like, that's not my personality. I had to work. Taylor Sheridan's the producer of the show, and he's the one that writes. And she worked with him for a very long time, trying to get her character worked out to where she's this mouthy, aggressive, strong, female archetype in the series. But that's my wife's favorite character, obviously.
Yeah.
So my wife tries to emulate her all the time, and so if you watch it, you'll know where my wife gets her personality. So.
This is why Lance is allowed to go home, go to the office.
That's all I do. That is all I do. In the gym. That's it. So, because I have to defend myself. Anyway.
Against your wife?
She scares me.
Hey, mine too. It's okay. Okay.
All right. Midterm elections now behind us. That means that, of course, right now, I'm looking at one of our monitors, needed to control the House is 218. 217 of the seats are controlled by Republicans, 207 by the House. There's still nine races outstanding that will come in. So the margin of majority in the House of Representatives will be very slim. Right now, there is a 50-seat Democrat lead over 49 Republicans for the Senate, with one race in Georgia still pending. That's the Herschel Walker, name escapes me, his opponent. I'm sorry. Anyway, the Herschel Walker race in Georgia, that will be the deciding seat. So if it does go to Herschel Walker, that'll give the Republicans 50 seats. Of course, Senate's then controlled by the Democrats because Kamala Harris, as vice president, acts as the tiebreaker vote. So what does that mean for taxes in a gridlock Congress? That's the big question, right? Because as you start looking forward, obviously, if Democrats had held both House and Senate in this election process, that would open up the door again. Now remember, over the last 2 years, lots of talk, and Danny and I and Richard all had lots of conversations with people over the last couple of years, because there was one attempt after another to pass higher taxes on the wealthy, which, if you're listening to a financial talk show at 6:51 in the morning, you're probably in that bracket. So taxes would affect you. Now, the issue becomes, of course, now with a divided House, or a divided Senate and House, that's going to keep the risk of higher taxes potentially off the table. So what does that mean for planning purposes right now, Danny, as you start to think about 2023 and IRA, Roth IRA conversions and those type of things? Does that remove any of that need?
Well, no, I don't think it removes the need. I think it certainly it just delays it a little bit. Where if we would have found out that there was not a divide, or the Democrats would have won the House and the Senate, I think we'd be a lot more prone to say, hey, we need to be a little bit more aggressive right now. We do know what they've tried to do this last year in the sense of raising taxes, or reducing the estate tax number as far as what's exempt. I mean, there's so many little things that they were doing that were going to potentially really impact a lot of people. And they've talked about it. This isn't something that they didn't campaign or talk about. They've been talking about raising taxes. At some point, they're going to do it. And look, it's a function of math. It doesn't matter what side of the aisle you sit on. This will have to be done. But I think we're going to have a couple years now. This current tax code, the Tax Cuts and Jobs Act that was enacted here in 2017, I think we're going to get this, that sunsets in 2025, at the end of 2025. So we step into 2026. Everything's going to revert back. We're going to see an estate tax is going to be half of what it is today. We can, right now, there's a lot of people, we deal with a lot of people who are wealthy in many different ways. I mean, we see a lot of people who own a lot of land, where on paper you look at these people and say, wow, these guys are, they've got a lot of money. Well, they may not have a lot of money that's at their hands right now. And essentially, you could see that properties liquidated, companies liquidated. They're talking about doing a step up, or reducing a step up in cost basis, increasing the estate tax. Currently, the estate tax for 2023 is going to be $12.92 million per person. So that's quite a bit, right? There's not a whole lot of people that are over that number. But for those of you that are, you need to be doing some planning. Now that number's cut in half. That's going to be a significant problem that I think people are going to have to face, Lance. And so this gives us a little bit longer. This gives us, 3-4 years here that we're going to be able to have to work with this. So we've got 23, 24, and 25. So I guess 3 years. Mm-hmm. And so I think that's going to be one of the bigger things people will be looking at. But, another one that I think that a lot of people don't even realize is capital gains tax. Right now you can be at the 0% tax rate if you make under $83,350. So you may be selling stocks this year at a gain, but if you made $60,000 and you take, after your standard deduction or itemized deductions, and you take a $20,000 gain, that's at 0%. Mm-hmm. I mean, that's not a bad thing. And I think that people, they're not as aware of that as they should be. And so, understanding how the tax brackets work, how capital gains taxes work, that's something that's really important. Now, we talk about tax loss harvesting. We've been talking about it quite a bit here towards the end of the year. Something that, this time of year comes around, we're always looking for opportunities. Last year didn't have a whole lot of them. This year have quite a bit more that we could work with. But sometimes, it's just from an investment standpoint, we need to make shifts and changes. And, hey, this investment didn't work. It's time to get out. Let's try something else, try something similar. those are things I think that people should be looking at right now. Another thing that we've had a lot of clients do, especially if you've had a big year, we do have a lot of clients who've been laid off or who've retired early. They've received large pensions or large payouts. This is a time that if you're charitably inclined, you should start looking at bunching or bundling. So just to give you a real easy, quick example, let's say that you donate $10,000 to the animal shelter or your church every single year. And instead of doing it, each year $10,000, you could actually get a tax break right now, put it into a donor advised fund, and still, or a private charitable foundation, still get the tax break for this year. And say, let's say over the next 5 years, you want to give those funds out, but you want to put $50,000 aside right now. You get that $50,000 break, which is a really nice aspect, or something that you should be considering if you've had a really nice year from an income perspective. And so these are little tips that we're seeing a lot of people do. But I think with what the midterms election have done, especially, you mentioned the Roth conversion, Lance, instead of, we had some people that said, look, here's what we think you want to do. But if November goes like this, we're going to go ahead and do it all, because who knows what 23 is going to bring. Yeah. But if we get a split or it goes one way, then I think we have a little bit more bandwidth here where we can do a little bit at a time, a little bit over the next couple of years, and not have as big of a concern. Now, does that mean that nothing can happen? There's no way they can raise taxes? Absolutely not. They certainly could, but we just want to be able, try to make the best moves now to keep more money in your pocket out of Uncle Sam's, and that's going to be the key. Because taxes are coming. It's not if, it's just when, and how high will they go? I mean, that's anybody's guess. Yeah. So we're doing a lot of hypotheticals.
Yeah. Where else you can bundle?
What's that?
Progressive insurance.
Progressive insurance.
You can bundle.
How long have you been waiting for that one?
I was waiting that whole segment.
I know.
I was also thinking about, Danny and his wife. Danny subscribes to the happy wife, happy life motto.
Oh, no doubt.
He takes her flowers. Sure. All that. I subscribe to the moderately irritated, amusing life. So,
Oh, I don't know. I'm pretty irritating, I'm sure.
Interesting comparison, life expectancy of those two theories.
Yes, much shorter, and that's why I have a good insurance policy. Mm-hmm. I thought it was interesting, just a few moments ago while we were talking, NASA launched the Artemis rocket into space. And what's interesting is so if all goes well, so that's Artemis 1 that they've now launched into orbit. If all goes well, this is a line from the statement. If all goes well, Artemis 2 mission could propel 4 astronauts for a flyby mission around the moon in 2024. Then by 2025, Artemis 3 would allow for the first crew moon landing on the moon. Now, see, this is an interesting statement, right? I know, and you're looking at me funny because I'm about to explain why Danny's looking at me funny. See, this is the problem when there's a big gap in history, and you lose a lot of the geniuses that we've had. They've gotten old, they've died off, etc. They've left NASA to go do other things, or go to a grave. We've done this before. It was called the Apollo missions, the Mercury missions. We sent people to the moon already, and they did it with the memory of a TI calculator and lots of slide rules. And now we have all this computer technology, and we're having to recreate the wheel all over again because of this long gap in history. We've now got to go through those same steps all over again. Into orbit, fly by the moon, eventually land on the moon. Again. That wraps up the show for the day. And as we get older, Danny will eventually replace us, Brent.
Oh, man.
And he'll have to learn this all over again. Get by the website. The economic outlook for 2023 will be up on the website tomorrow?
This week.
It will be up this week. So just cruise by Real Investment Show. We'll let you know when it's up. RealInvestmentAdvice.com. That's RealInvestmentAdvice.com. Have a great day.